Crypto taxes explained. What the IRS wants you to know. The IRS just sent out a notice last month reminding brokerages they're hunting for unreported crypto gains. And if you've traded even once on Robinhood, Coinbase, or Kraken, they literally have your data already. Hey, I'm breaking down exactly what crypto taxes actually mean for your wallet. Because the difference between knowing this stuff and ignoring it could cost you thousands in penalties you didn't see coming. Let's go. Part 1. The basic rule that changes everything. Here's what most people get wrong. Crypto isn't special to the IRS. It's property. That's it. The moment you own it, the IRS classifies it exactly like real estate or stocks. This matters because property has a tax event every single time you sell it. Every trade counts, not just when you cash out to dollars. Let me show you what this actually looks like. Say you buy one Bitcoin for $30,000. The price jumps to $35,000. So you trade it for Ethereum. That $5,000 gain? You owe taxes on that right now. Even though you're still holding crypto. Even though $0 hit your bank account. This is called a taxable event. And it happens on every swap, every conversion, every trade. Most people miss this completely. They think taxes only matter when they sell for USD. The IRS knows this too. That's why they're aggressive about it. Your tax bracket determines your rate. And for most Americans in the 22 to 45 range reading this, that's probably 22 to 35% federal plus your state taxes. So that $5,000 gain I mentioned could actually cost you $1,200 or more depending where you live. Part 2. Long-term versus short-term. The difference that matters. Here's where you can actually save money. Timing. If you hold crypto for more than 1 year before you sell, the IRS taxes you at the long-term capital gains rate. If you live in America and your income is under $250,000, that rate is usually 15%. Way better than short-term, which is your regular income tax rate. Let me put this in numbers everyone understands. You buy $5,000 of Ethereum on January 15th. It grows to $10,000. If you sell on January 14th the next year, you pay roughly $5,300 in taxes at short-term rates. If you wait one more day and sell on January 16th, you pay roughly $1,500. Same gain. $3,000 difference. Just from timing. This is why holding actually matters financially. It's not just HODL philosophy. It's actual money. But here's the trap. Most people accidentally trigger short-term gains because they don't track this. They trade casually, lose count, and boom, they owe money they didn't budget for. Part 3. What you actually need to do right now. First, if you've traded crypto in the last 3 years and haven't reported it, you need to know that the IRS has already been sent Form 1099-K from your exchange. They know. They're just deciding whether to go after it. Start tracking everything immediately. Every single transaction. The date, what you bought, what you paid, what you sold it for. Services like Coinly or CoinTracker automate this if you connect your exchange accounts. They pull all your trades, calculate your gains and losses, and generate tax reports. This matters because the IRS wants to see that you reported what they received from your broker. Discrepancies trigger audits. Second, consider tax loss harvesting. If you have losing positions, selling them before the year ends lets you offset your gains. You sell an altcoin down 50%, lock in that loss, and use it to reduce your tax bill on your Bitcoin gains. It's completely legal and smart people do it every year. Think about this strategically instead of emotionally. Third, if you made money, set aside cash now. 30 to 40% of your gains should sit in a savings account or high-yield savings account, earning 3% at Fidelity or Marcus. Don't spend it thinking you'll pay taxes later. The deadline is April 15th. If you owe $15,000 and spend it, you're in trouble. Final word. The smartest investors treat crypto taxes like they treat 401k contributions. Seriously and in advance. You don't wait until April to figure out your 401k. Don't wait until April to figure out your crypto. The IRS isn't trying to trap you. They just want consistency and honesty. Track your trades. Understand your bracket. Hold when it makes sense. And most importantly, set money aside. If this helped you understand how this actually works, hit subscribe. We break down financial strategy for people who actually want to win with money. See you in the next one.